Warren Buffett Best Dividend Investing Strategy for 2023. If you ask Warren Buffett about the minimum capital to start investing in stocks, he would definitely say that there is nothing like a minimum or maximum to jump into the stock market, and he is probably right. There is a secret strategy applied by Warren Buffett. It's known as Buffett's dividend investing strategy. By applying the same strategy, you can earn greater returns reward in the future, and you can also create a source of passive income. Hello there, welcome to our channel Stack and Invest, the channel where financial freedom meets the power of knowledge. This video is going to change your financial instability in the future. So if you are worried about your future and if you want to learn about a stable income source, don't skip a single second of this video. So now, without waiting a moment, let's get started. Before we understand Buffett's investing philosophy, we must know what value investing is. Value investing is actually the concept of investing in stocks for less than their intrinsic value. It's like there is a Picasso painting in a yard sale, and you have the true sense of the art but others don't. Intrinsic value means the actual worth of a company, taking into account tangible and intangible factors, from its assets and earnings to its brand value and competitive position. According to Mr. Buffett, dividends are a tangible representation of a company's intrinsic value that lets you know its ability to generate cash. A company with a steady or growing dividend is a signal of having strong intrinsic value. Dividend investing is more about quality and less about quantity. When it comes to dividend investing, most people chase stocks with high yields. But Mr. Buffett is completely against this mindset. He firmly believes in the mantra of quality over quantity. His primary focus is always on the health of the underlying businesses and their ability to grow sustainable dividends. For Buffett, a moderate dividend-paying company is a better option than a high dividend-paying company with shaky history and instability. After learning Buffett's perspective, let's see how he actually makes money out of his dividend strategy and how you can do the same. Lesson 1: Patience is the key. Whenever we talk about Warren Buffett's investing strategy, always remember that having patience is more than anything in the game of the stock market. Buffett frequently says, "The stock market is a device for transferring money from the impatient to the patient," and of course, his investment history is enough to prove the soundness of his philosophy. Lesson 2: Finding management's approach to capital allocation. Now, here is a question for you. Before investing in any stock, what data do you study? A. Balance sheet. B. Income statement. C. Current market status. I assume that many of you will go with any of these options, but you know what? This is not how Warren Buffett makes a decision. Warren Buffett's approach to finding the real value of a company goes beyond its balance sheet and income statement. He drives his focus on the company's management, especially their approach to capital allocation. Management's decisions on reinvestment in the business, paying dividends, and buying stocks have a great impact on shareholder value. Oracle of Omaha respects management that can maintain a balance between investing for growth and returning cash to shareholders. According to him, companies that pay consistent dividends without compromising their financial health are more reliable. In the chessboard of the stock market, the dividend is an important move in the game. The management who knows when to move the pawn, when to guard the queen, and when to reward their players with dividends is the master of the investment game. Here the terms pawn refers to reinvest, queen means maintaining cash reserves, and rewarding their players means paying dividends to the shareholders. Lesson 3: Learn risks and limitations. After learning lesson number 3, we can easily assume that Buffett always prioritizes the importance of strong company management, and definitely, it's logical. However, this dependency also has a dark side. Let's say there is a company with a strong management team and Buffett invests billions of dollars. Soon, the company started losing its momentum or its decision-making ability became questionable. In such a scenario, the company can lose its value to the shareholders. Additionally, we should not neglect the fact that sometimes the best management teams can't analyze the turbulent market conditions or a sudden drop in the stock market, just like we've witnessed the corona pandemic. This reminds us that some forces outside are out of our control. Lesson 4: Potential for missed opportunities in high-growth, low-dividend sectors. We all know that the master of investment Warren Buffett mostly prefers companies that pay stable and growing dividends. However, this approach also has some drawbacks. You may miss out on opportunities to invest in high-growth industries that hardly pay dividends. And that's why Warren Buffett keeps himself away from technology and biotech startups. Yes, of course, Buffett acquires 895 million Apple shares, approximately worth $148 billion. But we can consider that as a notable exception, while following the psychology of keeping your investment away from such sectors. Protects your hard-earned money from the volatility associated with high-growth, low-dividend sectors. It also means that you may miss out on remarkable growth opportunities. Here, Buffett's approach is a reminder that every strategy has its dark side. Some dividend investments that made Warren Buffett a master player. A. Coca-Cola. Whenever you pick a bottle of Coca-Cola, a share of the profit goes to Buffett's portfolio. It was 1988 when Buffett bought shares in Coca-Cola. Today we know how accurate Buffett's decision-making ability is. Since 1988, Coca-Cola has proved itself to be a truly top dividends-yielding company, increasing its payouts for over half a century. B. Apple Inc. The next master investment stroke of Oracle of Omaha is the tech giant Apple Inc. This partnership between Apple and Warren Buffett has raised many eyebrows. The reason is obvious. Buffett has always maintained a distance between himself and tech stocks because he never invests in business models he doesn't understand. However, Apple Inc. has all the characteristics that Buffett always looks for, such as a strong brand, a loyal customer base, and a business model that gushes cash. Additionally, Apple has enhanced the agreement by offering an increasing flow of dividends and implementing an initiative to share the buyback program. Definitely, Apple is not a traditional dividend stock. Yet, its payouts have grown consistently, and that's what effectively boosts the value of Berkshire's stake. C. American Express. The story of American Express and Warren Buffett is known as a thrilling saga that dates back to the 1960s. The story has many twists and ups and downs. When American Express lost its trust due to being stuck in a scandal in 1963, it was Buffett who saw the company's long-term value and solid business model. At that moment, he made a remarkable investment, and today we know his faith was handsomely rewarded. Now let's conclude Buffett's dividend investing in 3 easy steps. First, study the performance of the companies with a consistent record of paying dividends. Then check if the companies reward their investors year in, year out. Finally, check out the consistency, since it's a perfect indication of a strong, resilient business. The next step is to list out the companies with a sustainable competitive advantage. In Buffett's words, the key factor of investing is not about companies' growth. It's more about the competitive advantage and the durability of that advantage. Finally, step number 3. Study the business model of the company properly. If you are going to invest in Microsoft, you must know how Microsoft makes money. In simple terms, Buffett calls it the circle of competence. It means trying to focus on those companies you can understand easily. That's it for today, guys. If you want to learn more about such strategies from millionaires of the world, make sure to click on the links given in the description. And yes, please tap the subscribe button so you never miss the future updates. Thanks for watching.